significant and really important to take a look at. Over the last few days, we have seen a few changes here and there when it comes to the market movement and what exactly is shaping markets around the globe. Today, though, we did see a sense of positivity come out of the markets, particularly out in Asia, as those shares were led higher, specifically then by hopes of better trading, specifically with the futures trading that came out of the United States. So that seemed to have done fairly well as well. The oil price hitting a 5-week high, so a really good number on that front. Some countries are putting in a whole lot of effort as well then in trying to get their economies back on board. So it does tell you a sense of where those things are going then as well. China's new home prices, though, those went slightly faster or grew slightly faster than in April than was expected as well then. So economists or investors really getting a sense of a positive market movement on that front. It does add to signs that the country's property market is getting better on that front. Over in Japan, unfortunately, that economy is officially in recession and back into that mark for the first time in 4.5 years. So a big deal for them there in that front. It does put the nation on course then for what is essentially their deepest post-war slump as the coronavirus crisis does ravage through that economy, unfortunately. The world's third largest economy, that is unfortunately falling off by 3.4% in the first quarter of the year. Also then, the U.S. Federal Reserve, Jerome Powell, coming out with statements in an interview yesterday and really saying that the U.S.'s economic recovery may indeed take some time. In fact, it may stretch deep into next year, and a full recovery may only be based on a vaccine being found then for the coronavirus. So more stimulus perhaps needed for the next 3 to 6 months for the U.S. economy is the supposition then coming through then from Jerome Powell as well, adding to a whole lot of that market uncertainty. Very quickly, though, let's unpack this. And what does this all mean, even for the local bourse, as it turns slightly positive, perhaps, in its ways? Let's chat to Gary Boyson, who's from Rand Swiss, who joins us on the line now. Gary, thank you so much for the time, but it certainly has been an interesting one when we first are getting a sense of positivity because economies are coming back online, but the fear of that second or rebound when it comes to coronavirus cases is also a scary one for the market to deal with.
Yeah, I think that's exactly what the markets are grappling with at the moment. It really comes down to the very, very poor fundamental data that we're getting out of the various economies around the world, but balanced against very, very accommodative monetary policy in the face of a world that is, in fact, opening up. People will start going back to work. Businesses will start operating again internationally. And as long as those infection numbers don't rebound aggressively, I think there's real hope that we're going to see the world getting back on track. You add the stimulus that Jay Powell was talking about over the weekend, and that ends up being fairly equity market positive. So if we look at our market today, we've got especially the basic materials, so the miners and the metals companies going up significantly. So you've got Sibanye up over 11% today, Impala up about over 7% today, and still, unfortunately, leading the downside is going to be the likes of the restaurant companies, things like Spur Corp down about 12%. But overall, the general market's up 2.79%, and it's a green day. It's everyone's feeling positive.
Yeah. What does it do, though, when you get companies who are deciding to hold back on some of their dividends, though? Does that actually change the market any bit?
Yeah, so it's an interesting question. So from a dividend investor's point of view, absolutely. When companies start deciding not to pay dividends, it's a huge impact to you. If you're a retiree, you're relying on that income flow to live. It's very, very important. And it really depends from company to company, like the significance to the individual investor. If you look at the kind of companies that have been cutting, you look at like the likes of Baldwin, they are essentially, they're just trying to protect their balance sheet. It doesn't do anything to the underlying investment case for the company. The company is just deciding in the short term to increase its cash balances, and that cash can always be paid out at a later stage via a special dividend, for example. So, holding back a dividend doesn't change the profile of the company. It's just potentially a more prudent management team holding on to some cash. On the other hand, last week we heard that MTN was actually increasing their dividend. Now, that is a sign that potentially a company might be in a stronger financial position, that the management team feels that they can increase the dividend. At the same time, there is always that concern that is this company going to extend its balance sheet too far by paying out that cash in a time where we have a huge amount of uncertainty and we're not exactly sure how cash flows are going to look, let's say 18 months down the line. So it's very difficult to tell whether the decision to hold back on the dividend is a dangerous one, and it really comes down to the company's specific circumstances.
Yeah, going to be so difficult then. Very quickly, Gary, we have actually run out of time, unfortunately, but that oil price going back above $30 a barrel, quite significant then to the market. Does it continue to go higher, you think?
Certainly, I think in the longer term, oil prices have to rebound. So we've seen very, very deep cuts by the oil industry. We've had 9 weeks of the rig counts falling, which measures basically what the supply side of the equation looks like. And then obviously we've also seen drawdowns in especially Oklahoma, which is, if you remember that WTI contract that traded negative briefly a couple of weeks ago, that was really about concerns about where to store oil. And seeing that some of the inventories have drawn down, that idea that we're going to reach tank tops, which is essentially when all oil storage is full and there's literally nowhere to hold the oil, that kind of fear has subsided. And with that, those inventory drawdowns, with the supply coming out of the market, with the idea that potentially we're going to see the global economy coming back on stream as businesses start to open, as the severest of the lockdown restrictions are eased, and we see a little bit of demand coming back in, people are starting to see that I think we're probably through the low in the oil prices, and that potentially the oil markets are going to return to a semblance of normality.
Do you think, though, that oil, the gold price going above then the key 1,700 and really looking to go ahead? It's now at some of its highest points in around 5 weeks or so and climbing. Does that bode well for the price? Does it show the safe haven nature is still intact within gold?
I think the safe haven demand for gold is only one part of the story. So absolutely, when people are panicky around a financial system potentially collapsing, they might increase their gold holdings, going and buying the Kruger coins, etc. That is one element of the demand. It also, I suppose, the idea that, and that's the idea that gold is a commodity. There's also the idea that gold is a currency as well. And with gold being a currency, you've got to look at it more in terms of, its relative appeal compared to other safe haven currencies like the US dollar, like other hard currencies also like the yen. In a situation where you have falling interest rates, so as the central banks, as the Reserve Bank locally cuts interest rates, the difference between holding, let's say, US dollars at a 3% interest rate or South African rand at an 8 or 9% interest rate becomes less significant. As those rates fall, it becomes more attractive to hold gold because, if you're looking at it and thinking, the Fed might be, expanding its balance sheet, it's essentially printing money, and I'm not going to get any interest in holding dollars, but there could potentially be a devaluation of dollars compared to hard assets. The decision on holding cash rather moves from holding dollars to holding gold. And that for me is very supportive. If we look at the historical data, we can see that after the 2008 crash, the last time we had very, very accommodative monetary policy, it took almost 3 years for gold to peak. So for me, are gold prices going to be supported? I would say yes. I would say you're probably going to see gold supported well into 2022, 2023.
Yeah, it certainly does get interesting. That gold price right now at $1,761 a fine ounce then for that yellow metal. Gary, appreciate the time. Thank you so much for that. Gary Boyson is from Rand Swiss helping us unpack that market movement so succinctly. $815 a fine ounce then for the price of platinum. Brent crude is at $34.49 a barrel. It's a massive 6.12% gain for that today. So certainly a big push there. Perhaps fuel demand coming back into play as well, and markets getting really interested as to where things currently fare on that front. And as you can tell there as well, 18.36 for a US dollar. Certainly the Rand performing 1% better off than one would have certainly thought at this stage. Hopefully we can get back below 18 Rand soon enough, but I suppose it will all depend on how things go when it comes to the coronavirus and its impact on the local economy. Well, tomorrow, of course, is the start of the South African Reserve Bank's Monetary Policy Committee meeting. we do have a sense of where exactly things might go. Perhaps another 50 basis point cut is what we will see. Let's find out soon enough. For me, though, that's where the buck stops. My colleague Nzinga Kunta joining you right after this. Do stay tuned. This is On Point.